Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we are taking a look at McDonald's because they had their second quarter earnings. We looked at this stock a little while back, and at that time, the price was 290. As of today, after hours today, it's 294.21. So it's up just over 1%. Very negligible move. It was put on the hold list. The biggest issue was debt for the company. So we'll take a look. They had positive earnings, see if that changes anything, and what they have to say about the outlook. I had placed some trades following the last time that we looked at this company because there's so much resistance around that $300 level. It definitely doesn't have the momentum nor the reason to break above that. So I've been doing call credit spreads, betting that it would stay below 305. And I've been pocketing some money on that. In fact, I made more money off that than I would have buying shares. I sold out of my position, even though I had given it a hold because I saw better companies on the buy list that I could put that money into. But last time we looked at it, here is where everything was at. So a fair value was right around 190 and a half. Uh, Margin of safety around 162, and then overvalued 210, and it was trading for 290, and today it's 294. So let's take a look at the numbers and see what's going on there. This is all the numbers that we looked at last time, so we really don't need to look too deeply into it. The big thing here is the year-to-date reported numbers and how close they are to being at their goal and how that impacts their value. So they're almost spot on the revenue, 49%. They might have a better few quarters coming up, so they might actually even be able to raise this, but we'll see after Q3. That'll give us a better picture. They don't report a lot of numbers. We'll actually look into the earnings report because there's not much here. I could not find anything on the balance sheet or the cash flows. They like to keep it very short. So they did give net income. They are at 58% of goal, so they will likely be outperforming on that. In order to hit their revenue goals, they definitely would be outperforming there. And the main reason for that is their margin. They are beating the margin that they've had previously. In fact, they're on track to have their best margin in the time frame that we take a look at. Earnings, they're spot on halfway through the year. And like I said, I can't find any of this other information. Looks like they don't give that out quarterly in their releases, so we might just have to wait till the annual to find out about all of this. But the big issue here was the debt. They are one of the few companies that I've seen where they have a negative shareholders' equity, which just means that they are loaded up with debts. We see here that their assets at the end of last year were 50.4 and their liabilities were 56.4. So they have more debt on the books than they have in assets. And so they ended up with a negative tangible assets and a negative tangible book value. Debt to equity ratio that is astronomical. 9.4. It's showing as negative because of the negative factors here. There were some year-over-year improvements in this metric, so we'll see how things go. I mean, we were looking based on how they typically perform for something around 5.4 negative tangible book value with a closing gap between assets and liabilities, but we'll see how that plays out. I mean, they have very strong free cash flows. I know a lot of that debt is real estate debt, so it's nothing too big that they need to worry about, but still, that's a lot of debt on the books. And they had said in their annual report for last year that they're expecting their interest payments to go up 10 to 12% this year for 2023, which would, of course, make that debt weigh even heavier on them as a company, raise their expenses. So if they continue on the trend, looks like they're probably going to come in at, if not above, these projections here. We'd be looking at a fair value around 240, up significantly from the 190. Margin of safety 203, overvalued 264. So that is quite a bit higher than where the stock currently sits, but it's getting close. In 2022 and the projections for 2023, they're showing double-digit growth in sales. So hopefully they can keep that up long term. They're really pushing mobile sales and drive-through sales, and they talk about that a bit in their earnings, which we have right here. So the most important thing here, always what the company is saying about their performance. Our second quarter results reflect consistently strong execution of our Accelerating the Arches strategy, with global comparable sales growth of 11.7% and double-digit comparable sales growth across each of our segments. So that's good news. Like I was saying, double-digit growth. McDonald's brand has never been stronger, and I remain inspired by the ability of the McDonald's system to create cultural conversation and develop industry-leading innovations. While global macroeconomic challenges persist, we continue to invest in our growth drivers and our brand to meet customer needs for tomorrow. So that sounds good. They definitely seem to have a positive outlook. And then little summary points here: 11.7% growth, 10.3 in the U.S., international 11.9. So the U.S. is what was driving that number down. Consolidated revenues increased 14%. System-wide sales increased 12%. Operating income increased 81%. And this is what I was saying, where they give just a general few numbers. Like we have the revenues, the net income, the earnings per share. So the spreadsheet was updated with these for 2023 thus far. And they have a little bit more down lower in this, where we can see the increase/decrease here. Revenues were up 18%. Sales by company-operated restaurants were up 12%. Revenues from franchise restaurants were down 2%. That's interesting. And other revenues were up 14%. Operating costs were up 18%. So it's great that the revenues were up 18, but the operating costs were up just the same. And they're pretty close numbers too. Let's say 2.5 compared to 2.1, like 18%. We're not quite to apples comparison, but definitely closer than other cases that we take a look at. Company operated restaurant expenses were up 5%. Other restaurant expenses down to, so depreciation was down. Total operating costs and expenses was down 15%. So that's good. They were clearly able to cut expenses elsewhere to make up for that 18% gain. Operating income up 81%. Earnings per share up 97%. Net income up 94%. Shares outstanding, so they've bought back 1% of shares. So the goal would be for them to buy back another 5 million shares over the rest of the year, which is pretty reasonable. They've already bought back 1%. I would really love to see the balance sheet information. I was digging and I could not find it. I looked all over their investor site. So we might just have to wait for the annual report to see that. And it's clearly a good company. I mean, it's definitely a strong brand that everyone knows, which holds some weight. But it's trading for a pretty exorbitant price, especially for the balance sheet that they're holding. I mean, that's just bringing down the overall value of the stock. The earnings are great. The dividend is good. You're looking at something where it'd be overvalued, just around overvalued at the price that it currently sits today. And we'd really want to look for it to drop down to under 220. Do I think that's going to happen? Probably not, but it is a company to keep your eye on. in case that ever does happen. Some great buy opportunity at some point. Like you could have gotten it for a fair value back in 2020, just like every other stock. But that's all for this one. So I want to thank you guys for watching. Please like if you enjoyed the video, comment if there's any other stocks that you want me to take a look at, or if there's something that I missed about this one. And subscribe so you can stay up to date on everything. And I'll catch you next time.